There is a number that came out last month that should have stopped everything. It should have been the lead story on every financial news channel. It should have been the thing people were talking about at dinner tables and in office break rooms and on every personal finance platform that exists. It should have felt like a national emergency, because by every honest measure, that is exactly what it is. The number is $1.27 trillion. That is the current total of American credit card debt. Not mortgages. Not student loans. Not auto loans. Credit cards. The revolving, high-interest, minimum payment trap that millions of Americans carry in their wallets and try not to think about too hard. $1.27 trillion of it. More than at any other point in the history of the United States. A number so large that if you stacked $1 bills to represent it, the stack would reach the moon and back, twice. And the part that makes it a crisis rather than just a big number, the average interest rate on that debt is 23.72%. Nearly 24 cents of interest for every dollar owed, every year, automatically, without asking, without negotiating, without anyone having to do anything except carry the balance. My name is Astrid. And today, we're going to look at exactly how this happened, exactly who it's happening to, and exactly what it means for the millions of people who are carrying part of that $1.27 trillion in their pocket right now, possibly including you. Subscribe if you want to understand the financial forces that are shaping your life, whether you're paying attention to them or not. Let's start with what $1.27 trillion actually represents in human terms, because the abstraction of it is part of what makes it so easy to ignore. The New York Federal Reserve tracks consumer debt with a level of precision that most people never look at. Their most recent report didn't just give us the headline number. It gave us the anatomy of it. The average American household carrying credit card debt has a balance of $6,580. Not $200. Not $1,000. $6,580. And at 23.72% annual interest, that balance generates $1,560 in interest charges per year, $130 per month, before a single dollar of principal is reduced. That means someone with $6,580 in credit card debt who makes the minimum payment every month is paying $130 just to keep the balance from growing. They're not reducing the debt. They're paying for the privilege of still owing it next month. And here's the detail that makes this worse. 61% of Americans carrying credit card balances have been in debt for at least 1 year. Not a short-term bridge between paychecks. Not a strategic float. Chronic, sustained, accumulating debt that has become a permanent feature of their financial lives. More than half of the people carrying this debt have been carrying it for over a year. Many for several years. Paying interest month after month on balances that are not going down, in some cases going up, at 23.72%. This is not a number. This is millions of people quietly drowning in slow motion. Now let's talk about how it got to $1.27 trillion, because understanding the mechanism is what makes it possible to escape it. Most people assume credit card debt is a discipline problem. People spending beyond their means. Buying things they can't afford. Making impulsive decisions they later regret. And while that story is true for some portion of the debt, the New York Fed's analysis of what's actually driving the current record is significantly more uncomfortable. The leading cause of new credit card debt in 2026 is not discretionary spending. It is day-to-day expenses, groceries, utilities, gas, medical copays, car repairs. The ordinary, unavoidable, non-negotiable costs of existing, costs that have risen significantly due to inflation, tariffs, insurance increases, and the general upward pressure on the price of everything over the past 3 years. People are not going into credit card debt because they bought a big television or took an extravagant vacation. They are going into credit card debt because their income has not kept pace with the cost of their ordinary life, and the credit card is the only bridge available. Think about what that means structurally. When someone uses a credit card to buy groceries because their paycheck doesn't quite cover everything before the next one arrives, and they carry that balance at 23.72% interest, they're effectively paying 24% more for those groceries than someone who can pay cash. The financial penalty for not having enough money is paying more for everything. The system extracts more from the people who have less. We've seen this pattern before in this channel. The tariff burden falling hardest on lower-income households. The car payment trap consuming the highest percentage of income from people who can least afford it. And now this, the highest interest rates in consumer finance being paid by the people most likely to be using credit cards out of necessity rather than convenience. The $1.27 trillion is not a story about bad choices. It is a story about a system that has become extremely efficient at capturing people when they're vulnerable and keeping them there. Now I want to show you the math that nobody shows you when you're applying for a credit card. You have $6,580 in credit card debt. Interest rate 23.72%. Your minimum payment, which the card calculates as approximately 2% of the balance, is $132 per month. If you make only the minimum payment every month, which adjusts down as the balance decreases, here is what happens. You will make payments for 28 years. You will pay $9,340 in interest alone. Total paid to eliminate $6,580 of debt, $15,920. You borrowed $6,580. You paid back $15,920. The difference, $9,340, went to the bank. For nothing. For the privilege of using money for a while. 28 years. On a $6,580 balance, now let's say you're more aggressive. You pay $250 a month instead of the minimum. Fixed payment, every month. At $250 a month, you pay off the $6,580 in 32 months, less than 3 years, and you pay $1,356 in total interest. That's dramatically better. But it requires finding $250 a month that isn't already allocated, which for someone using their credit card for groceries because the budget is already tight is not a trivial ask. This is the trap at its most mechanically perfect. The minimum payment keeps you in the game long enough to pay back more than double what you borrowed. The aggressive payment requires resources that the person most likely to have this debt is least likely to have available. And the interest compounds every single day, not every month, so every day you carry the balance, the debt gets slightly larger. The system is not neutral. It is designed legally, intentionally, openly, to extract the maximum amount of money from the maximum number of people over the maximum amount of time. The 23.72% rate is not a mistake or an aberration. It is the product, and here's where 2026 specifically makes this worse in a way that hasn't been fully discussed anywhere I've seen. The Federal Reserve cut rates 3 times in 2025. 3 times. When that happens, most borrowing costs go down. Mortgage rates go down. Auto loan rates go down. Personal loan rates go down. Credit card rates did not go down. The average credit card APR in 2024, before the rate cuts, was 21.47%. After 3 Federal Reserve rate cuts totaling 75 basis points, the average in early 2026 is 23.72%. It went up by 2.25 percentage points, while the benchmark rate went down by 0.75 points. This is not an accident or an oversight. Credit card issuers are not required to pass rate cuts to consumers. They passed every rate increase directly and immediately. They have passed exactly 0 of the rate decreases. The relationship between Fed policy and your credit card rate is entirely asymmetric. It moves against you when rates go up, and stays against you when rates come down. If you had $6,580 in credit card debt when rates were at their peak and you're still carrying it now, your interest rate has gone up since the Fed started cutting. You are paying more interest today on the same balance than you were before the rate cuts that were supposed to make borrowing cheaper. That is what it means to be inside the system. So what do you do if you're carrying part of the $1.27 trillion? Because this video is not useful if it ends with credit card debt is bad, and here's a scary number. You knew credit card debt was bad. The question is what you actually do about it. First, stop treating all your debt as one thing. Credit card debt at 23.72% is not the same as a mortgage at 6.5%. It is not the same as a student loan at 5%. It is not the same as a car loan at 7%. The interest rate differential means that $1 of credit card debt costs you more than 3 times as much per year as $1 of mortgage debt. Prioritize accordingly. Every extra dollar you have goes toward the highest interest rate debt first. This is not a principle of financial virtue. It is arithmetic. Second, stop making the minimum payment the baseline. The minimum payment is not designed to help you pay off your debt. It is designed to keep you in the system as long as possible while paying as much interest as possible. Look at the minimum payment on your statement. Then look at what the card projects your payoff date to be at that payment. That date will be years from now, possibly decades. That is what the minimum payment is actually for. Third, if you have multiple credit cards, look at balance transfer options. Many cards offer 0% introductory rates on transferred balances for 12 to 21 months. Moving $6,580 from 23.72% to 0% for 18 months and making aggressive payments during that window is not a financial trick. It is understanding how the system works and using it in your favor for once. The transfer fees, typically 3 to 5% of the balance, are almost always worth it when the alternative is 23.72% for that same period. Fourth, and this one is psychological as much as financial, stop using the credit card that has a balance for new purchases. Every new purchase on a card with a balance is charged interest immediately because when you carry a balance, the grace period disappears. You lose the float. Every coffee, every grocery run, every gas station stop goes on the card and starts accruing interest the day you make it. If you cannot pay the card off in full every month, it needs to stop being used for daily purchases until the balance is cleared. Fifth, understand that the emergency fund and the credit card debt exist in direct conflict with each other, and you have to resolve that conflict deliberately rather than letting it resolve itself badly. Here's the tension. Financial wisdom says to have 3 to 6 months of expenses in an emergency fund. Also, financial wisdom says to pay off 23.72% interest debt as fast as possible. You cannot do both simultaneously with limited income. The answer most financial advisors land on is a small emergency buffer, $1,000 to $2,000, enough to handle the most common unexpected expenses without going further into debt, while aggressively attacking the credit card balance. Once the credit card is clear, redirect that payment into building the full emergency fund. The sequence matters because carrying 23.72% debt while holding excess cash in a savings account earning 4.5% is mathematically irrational. You are paying 19 percentage points of net interest for the psychological comfort of seeing money in savings. The $1.27 trillion is the number. But the number that matters for your life is whatever portion of it you're carrying. And the most important thing I can tell you about that portion is this: it is not evidence of irresponsibility. It is not proof that you don't understand money. For a significant majority of the people carrying this debt, it arrived the way it always arrives, gradually, then suddenly, through a combination of costs rising faster than income, one unexpected expense that didn't fit in the budget, and a system that extended credit at the exact moment you needed it while quietly setting the terms of repayment in its own favor. You did not fail. You got trapped. Those are different things, and the way out of a trap is not guilt or shame or the vague intention to do better. The way out is the specific, sequential, mathematically ordered set of decisions we just walked through. Stop the bleeding. Prioritize the highest rate. Use the system's own tools, balance transfers, promotional rates, when they work in your favor. Rebuild the buffer. Then never let the balance accumulate again. This is not complicated. It is just clearer when someone lays it out without making you feel bad about how you got here. $1.27 trillion is the crisis. Your portion of it has a solution. Start with knowing exactly what you owe, at exactly what rate, and what the minimum payment is actually costing you over time. Those 3 numbers, seen clearly, change the entire relationship. I'll see you in the next one.